the Federal Reserve has got to try and cope with a period whereby the US tax season is starting, in full in April. And what you're likely to see is a lot of liquidity being drained out of money markets in America to basically pay the US Treasury, and that will be money that will deplete liquidity for sure. So that's number one, and that challenge really has to be overcome. And the question is, does the Federal Reserve allow bank reserves to drop and money market liquidity to drop, or do they actually try and offset that in some way? Now, I think that the tools they've got and maybe some of the soundings they've made would suggest that they're not prepared to meet that challenge, and you may get a dip in liquidity, in which case markets may correct. So that's the very short term. The medium term takes us probably out a year and a half or so, really to the back end of 2025, and that's always been the period when we think the liquidity cycle is still expanding and basically hits a peak. So we still think that generally the trend or the cyclical upswing is intact, certainly for probably another 15 months. I mean, that should be the backdrop.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back Michael Howell. So Michael is the founder and managing director of CrossBorder Capital. So Michael, thanks so much for coming back on the podcast today.
Pleasure, Anthony. Good to be here.
Yeah, I'm glad to have you back because I know last time we were talking, you're obviously the king of liquidity. It's something that you look at quite in depth. And last time we were talking, you were saying that you think liquidity is looking good for the markets. And I guess if we look at what's happened in assets, it has been good. So for your perspective at the moment, where are we currently at in liquidity, and what is your outlook?
Well, I think you've got to sort of divide the outlook up in terms of maybe three segments. The first thing to say is, what is the very short term? And by the very short term, I'm really thinking about the next maybe 4 to 8 weeks. I mean, just think of a couple of months hence. I think that may be a slightly nervous time, and when there are challenges that are coming up. One of them really focuses on the Federal Reserve, and the Federal Reserve has got to try and cope with a period whereby the US tax season is starting, in full in April. And what you're likely to see is a lot of liquidity being drained out of money markets in America to basically pay the US Treasury, and that will be money that will deplete liquidity for sure. So that's number one, and that challenge really has to be overcome. And the question is, does the Federal Reserve allow bank reserves to drop and money market liquidity to drop, or do they actually try and offset that in some way? Now, I think that the tools they've got and maybe some of the soundings they've made would suggest that they're not prepared to meet that challenge, and you may get a dip in liquidity, in which case markets may correct. So that's the very short term. The medium term takes us probably out a year and a half or so, really to the back end of 2025, and that's always been the period when we think the liquidity cycle is still expanding and basically hits a peak. So we still think that generally the trend or the cyclical upswing is intact, certainly for probably another 15 months. I mean, that should be the backdrop. And then if you look longer term, and I'm talking here about maybe 5-10 years, the liquidity outlook, I think, looks generally very good. And the backdrop is one which is, again, challenging in many ways, but it really comes back to the fact that the fiscal backdrop of the West in general, I'm talking here of Europe and the US, is significantly challenged by a clear deterioration in revenue expectations versus outlays that are mandatory and basically represent entitlement spending. So government deficits are going to skyrocket, and you're going to get debt really just escalating, and that debt has to be funded somehow. And the only route out in a world of geopolitical tensions is to lean more and more heavily on the central banks and the domestic banking systems to do that. And that's pure monetization. So in other words, global liquidity is going to be rising significantly on a medium-term view.
Okay, no, thanks for laying that out. So if we focus on the short-term view, you mentioned sort of tax receipts. I'm assuming that's something that's probably an annual occurrence that they have to, liquidity has to deal with. So does it look any different this year? Is it, I guess, why are you thinking that?
Well, I mean, without getting too wonkish in terms of understanding the mechanics of the Federal Reserve balance sheet, what you've had in the course of maybe the last 15 months since around October of 2022 is that the Federal Reserve, although it's been engaged ostensibly in what they call quantitative tightening, which is a way of squeezing liquidity out of the system, allegedly, what's actually happened, paradoxically, is that liquidity conditions have actually eased. So on the face of things, their rhetoric is that they're taking liquidity out, they're tightening, but in actual fact, the reality is that liquidity is going up. Now, how do you square the circle in this case? You square the circle by saying that there are other things going on the balance sheet uh, on top of the actual sort of roll off of treasuries that they've been holding. In other words, the QT process that they define represents them allowing treasuries to essentially naturally mature and roll off the balance sheet, which is actually means taking liquidity out of markets. Now, there are other items on the balance sheet that are more than offsetting that. One of those is something called the reverse repo account. Again, that's a slightly wonkish concept, but basically, in a nutshell, what that really means is that was a sink or a way of holding liquidity out of markets on the Federal Reserve balance sheet, liquidity that was not being circulated, and it was being, if you like, lured there or enticed there by a generous interest payment. And the Federal Reserve has basically decided in the course of the last year or so to actually run that reverse repo account down. And that has been a source of liquidity, very significant liquidity inflow into markets. The rundown has basically added up to almost $2 trillion of extra liquidity. So it's not insignificant by any means. The other thing that comes into account, which again is a slightly wonkish concept, but let's press on, is something called the Treasury General Account. Now, the Treasury General Account is the bank account that the US Treasury holds at the Fed. If the Treasury is getting more tax receipts than it's paying out in outlays, that account will bulge or swell in size. If the government is paying out more money than it's getting in tax receipts, then that account will come down, and that will be a source of liquidity injection. Now, what's happened over the course of the last year is that account has generally added to liquidity, but the fact is that it's highly cyclical and it responds to the seasonality in the tax payment through the year. So April tends to be a month when tax receipts tend to swell significantly. People are paying their annual tax bills, and therefore that's a time when money is taken out of markets and the TGA, the Treasury General Account, tends to grow in size. Now, why is it very significant this year or right now? Really for two reasons. One is the reverse repo account, which has fallen significantly, is starting to stabilize now, albeit at low levels. There may be some potential to run it down, but I think the odds are that it more likely in the next few weeks is going to actually build up a little bit again, because there is no treasury bill issuance from the US government. They're actually moving towards coupon issuance and away from bills, and that may well force money market funds back into the reverse repo account. The other thing is that the tax payment season is likely to be very buoyant, simply because the US economy is strong and because Wall Street in the last 12 months has been extremely, has been rampant, which has basically pushed up capital gains. And that's normally a very good heads up to the strength of the tax paying season. So on those two accounts, that's where you've got this liquidity air pocket potentially facing investors.
Okay, that's really interesting. And I know a lot of people have been quite concerned that the reverse repo is actually going to run out. But you're saying that it's probably going to stabilize. There could be a small increase because of those. Yeah, there's no coupon or there's no issuance in the near term.
But that's negative for liquidity if that
Yeah.
happens.
Yeah, because I guess as you said, the reverse repo money coming out of that has actually helped sort of the Fed with liquidity while doing QT. So that could
Correct.
be sort of double whammy that we're not actually getting that at the same time that QT is coming out of
Yeah.
the.
Exactly.
Okay.
The other thing I think one needs to throw in here, because there is altogether way too much focus on one central bank, namely the Federal Reserve. One needs to look more broadly at what other central banks are doing. Now, I say that in really regard for two things. One is to question what the People's Bank of China is doing, and the PBOC is the second most important central bank in the world, and actually the most important central bank when it comes to understanding the impact of monetary policy on real economies. And that's simply because China's economic footprint is so large. So whatever the People's Bank of China does tends to show up not so much in financial markets, but in real economic activity. Now, what China's PBOC had been doing or has been doing for much of the last 6 months has been injecting huge amounts of liquidity into Chinese money markets. And that has actually helped to turn the Chinese economy around. Now we're starting to see the early signs of that being impacted. So if you look at commodity markets, they're beginning to strengthen. If you look at Asia Pacific trade volumes, they're actually surging. And this is all indications that the PBOC has been easing. However, there's always a proviso here. In the wake of the end of the Lunar New Year, so we're talking about end of February through the first half of March, the PBOC has actually not been adding liquidity at all. So what you've had is a natural roll-off of liquidity in Chinese markets. And that has effectively, the net of the net has meant that there's actually been some tightening by the PBOC. Now, the reason for that may be technical, it may be accidental, there may be nothing deliberate going on here, or it may be an attempt to try and stabilize the yuan. However, in recent days, what you've seen is the yuan weaken significantly, and it may be an indication that the Chinese are now prepared to actually ease liquidity a lot more in coming weeks. And that's the stance we take. We've long had the view that the yuan, the Chinese renminbi, in other words, is likely to be a weak currency this year. And that would give the Chinese, if you like, some opportunity against that backdrop, rather than sort of trying to hold the yuan up against a strong dollar, is actually to allow the yuan to weaken and therefore by that to push more liquidity into markets. So that would be positive for the world economy and generally positive for financial markets if the PBOC continues to do that. Now, the corollary of that would be that the Japanese therefore allow the yen to weaken, and that seems to be what's going on. And I would imagine that you've got a backdrop here whereby the inclination of many countries around the world would be to allow their currencies to weaken against the dollar, and therefore that would signal the fact that they're more than prepared to let monetary policy ease. Now, if having made that statement, we face a situation where the dollar itself may come under pressure, downward pressure, because of uncertainty about the election, the upcoming election, or uncertainty about the strength or robustness of the US fiscal situation, if the dollar therefore started to weaken, you may therefore get an opportunity for many other governments to actually begin to ease their monetary conditions a lot more aggressively. And I think that's the state we're in, because as far as I can see, if you listen to what the ECB is saying, or you listen to the PBOC is saying, or you listen to the Bank of Japan, they all want to ease now, and they see this as an opportunity. So I think what you may be seeing is a period where we get some coordinated easing from policymakers worldwide, and that's clearly a significant, a significant event.
Yeah, no, that's really interesting. And sorry, before so many questions from that. So maybe before we get on to the world stage, if we go back to the US, do you think there's a risk that potentially with their, I guess, tax income, they've maybe estimated that inflation remains high? Because if we look at the past few years, taxes have gone up quite a lot because of inflation. And I think we saw in France recently that their estimates of the deficit were actually a lot worse, or I think 0.5% of GDP worse than previously estimated, because of they estimated that taxes would be higher than inflation. So do you see that as an issue, or do you think the capital gains from increase in valuation will sort of offset that?
Well, I think it's a long-term issue. I mean, I'm only saying here that we're getting a temporary situation where there may be a surge in tax revenues, but I think you've got to look at the context of the fiscal deficit. Looking at it not just over 1 month, but looking at over maybe 10 years. And if we look at the US, there are very detailed calculations or projections that are provided by the Congressional Budget Office in America. The CBO is a bipartisan organization. It's giving a neutral view, if you like, of what is happening. in terms of government finances. And if you read the CBO estimates, what they're suggesting is that the US deficit is basically running on at a rate of about 7 to 8% per annum over the next decade. I mean, these are, well, I'm not saying unprecedented numbers, but they're certainly unprecedented from perspective of running for a decade long. And we've seen occasionally deficits blow out to those levels. In fact, the US deficit this year may well be around 8%. But the fact is, we don't see these year after year after year. So what you've got is a situation where fiscal finances are deteriorating significantly on a structural basis. And they're deteriorating basically because of two factors. Number one is that you've got aging demographics and mandatory spending or mandatory outlays in entitlement spending is set to rocket because of aging populations. I mean, think of in America things like Medicare or Social Security. Now, we know that the welfare state system in America is not as generous as Europe, and therefore the European situation has got to be a lot worse. The deterioration in fiscal finances because of welfare is likely to be dramatic in the case of Europe, and the tax base is of a state where it's very difficult for any incoming party to say that they're going to raise taxes or even cut spending. So what you've got is a structural deterioration in government finances, and this is what comes back to the whole question about funding. How are governments going to be funded in the modern world? And I think that COVID was a very good heads up for us, because what governments did in the COVID period was they basically turned to the printing presses. They printed money. They issued government bonds, and the central banks basically took those government bonds up. They monetized. Now, if we look forward, what you've got is a very significant deterioration, as I say, structurally in government finances. You've got geopolitical tensions worldwide, which says that those countries, those rich countries outside of the West, such as the Middle East, maybe Asia, are less likely to accommodate those government debt issues now. They're more likely to want to put money into gold or diversify their assets rather more widely, and not commit themselves to Europe or the US as they once did. That will mean that the challenge of funding then comes back to domestic institutions in some way. Do you want to burden the private sector with this debt load? I mean, that would be, I think, catastrophic for economies and for financial markets. Or do you want to try and find a way out through getting the banking systems or the central banks to actually fund your spending? In other words, monetization. Now, I think that whether we call it kicking the can down the road or whatever, that is the path of least resistance that many politicians will basically face. And I think what they'll turn to for evidence is to look at Japan, because Japan has traveled down this road some years before. It's kicked the can down the road, for several years. And what they've done is to basically monetize their debt, their government debt. The central bank has basically held large amounts of JGBs, Japanese government bonds. It hasn't had a materially bad effect on the Japanese economy. Inflation is still very low, structurally low. They find it difficult to get inflation up. The Japanese economy may be lackluster, but it's not in deep recession. And I think this may be an outcome that policymakers in the West decide is worth trying. So I would suggest that what we're looking at is a world where either the central banks come in and do more QE. Now, whether that's labeled QE or QS, quantitative support, doesn't really matter, but they're going to take more of this debt on their balance sheets. Or they find another way out, which is actually forcing the banking systems, the high street banks, to actually take on more debt. Now, although that may seem a long shot, banks at the moment, and if you take the US as representative, banks hold about 15% of their balance sheets in government securities. Now, if we go back to the 1940s or 1950s, so going back 50, 60, 70 years, it was much more normal for banks to hold 50% of their assets in government securities. Now, albeit we were in a wartime situation then, but isn't this a war now? We've got a Cold War emerging against China, and we've got a war against demographics in our home countries. So it would kind of make sense from a policy perspective to actually allow banks to hold more debt, and that's clear monetization.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views. We've hundreds of thousands of different people listening in. So I just wanted to thank you. You know, I started this as a student. I'm now currently working and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So if you can, great. If not, no problem at all. Thanks for listening. And let's get back to the show. Can you maybe explain that relationship? Is it just the fact that the delta is still so wide compared to other?
Yeah, I mean, I think it's straightforward. And look, number one is that interest rates are completely irrelevant, and it's something that policymakers focus on, or they want us to focus on. But interest rates are a very, very poor guide to monetary conditions, and I can explain that. I'll show that in some charts in a moment. But I think that if you just go back and think in terms of what's happened in the last year or year and a half. We've had markets globally, financial markets rising, stock markets picking up significantly from the lows. Through that period, liquidity has been the major driving factor. Rising liquidity has pushed these markets up. And throughout that period, you've had a flip flop of interest rate expectations. Sometimes people are thinking interest rates are going up. Sometimes people are thinking that interest rates are going down. At the beginning of the year, people were factoring in 6 or 8 rate cuts in the US. Now they're saying they'll be lucky to have 3, but throughout that period, the market's still gone up. So interest rates don't really matter in that context. Secondly, if you drill down into the case of Japan and you said, well, okay, what they've done is they've pushed policy rates to slightly positive from negative. But if you look at the term structure of Japanese interest rates, that has not mattered a jot to short-term rates, say 1 year or 2 year rates. They're already pricing in positive numbers for policy rates in Japan. So the market's got there a long time before. And this is just a cosmetic showing by the BOJ to actually say that they're recognizing the fact maybe that a negative interest rate is not a sensible policy. So I think it doesn't matter a jot, and I think that it does not indicate in any way that Japan is tightening monetary policy. Now, to come back to the issue of why is it that you've got the yen weakening, I think the yen is structurally weak. I've made the point for the last 2 or 3 years that I think that the Japanese yen is a Trojan horse or a stalking horse for a weak Chinese yuan. I think it's been a deliberate policy mechanism that's been enacted in combo between America and Japan, trying to put pressure on China. It's been enormously successful because it's forced the Chinese to flip-flop significantly in terms of their monetary policy actions. It's helped to destabilize the Chinese financial markets, and it's caused the Chinese economy to sort of grind towards a halt. So I think that currency is a very, very important political weapon, and I think that's been used. So I certainly do not expect the yen to be a strong currency this year. Now, I've been a maverick on that. But I think that if you go back to the beginning of the year, it's the one consensus trade that everybody agreed on, that the yen would be a strong currency. I disagreed, but I think that I'm still in the right camp. The yen's not going to be strong, so that's really the backdrop. Don't look at interest rates. Now, what I can do is show perhaps why interest rates are less important, and maybe if we look at some slides. So the first slide that you can see is entitled the Global Liquidity Index. And this is showing the course of liquidity in the world economy. This is money flowing, an index of money flowing through world financial markets, going back to the early 1990s. And what it shows is gyrations, understandably, a cyclical movement. And at the top of the cycle, you see asset price booms. And at the trough of the cycle, you see banking crises. And everything is sort of unfolding as we would expect. You've had your banking crisis back about a year and a bit ago, when we're talking about the regional banking crisis in America, CSFB, the UK gilt crisis, etc. And we're now moving up. There's been a little bit of a downtick in liquidity in the last month for many of the reasons that I cited. And if we go on to the next slide, what that slide shows there is a much longer term perspective. Now, that longer term perspective begins in 1970. It shows the global liquidity index in black. The dotted red line shows the cycle, a sine wave that we put on top. That sine wave was estimated in year 2000, and it's been extrapolated ever since. So it's absolutely on track. And what it's suggesting is that the cycle bottomed in October of 2022 and is likely to peak out sometime in late 2025. And therefore, we're still in the upswing, and that upswing is encouraging for financial assets. Now, the way that we consider the markets, and I'll just run through 2 or 3 slides to show how this impinges on asset allocation and why everything is on track for what we believe is a very, very normal cycle, despite what economists claim, is that what you've got going on here in this diagram is a diagram that shows a notional liquidity cycle in orange, which runs through 4 investment phases that we entitled Turbulence, Rebound, Calm, Speculation. That leads the real economy or the risk cycle by around about, on average, about 15, 18 months or so. Again, that's very much on track. The cycle overall lasts about between 60 and 70 months. And we're basically in the phase now where we're coming to the end of the rebound phase and moving into calm. Now, this diagram that you can see, the following one, the area diagram with the red, orange, and green colors, is basically saying this is the world. What percentage of markets or economies worldwide are in each particular investment zone? And what that indicates is that the bulk of markets are currently in the green phases, which are basically distributed between what we call rebound or what we think of as calm, which are both benign areas for investment. The red area, which was dominant in mid 2022, is now fast is fast shrinking on that diagram. It's being dominated by the green areas, which is what we like, I suppose. To give that evidence in another way, this time series is showing movements in global liquidity in orange, and the black line is the value of all wealth portfolios. In other words, the return from investing in assets globally, and that includes gold, it includes residential real estate, it includes equity markets, bond markets, liquid asset returns, everything. And you can see how that moves with the liquidity cycle. Also in there are things like cryptocurrencies, so Bitcoin, etc. That tends to be a very highly sensitive asset towards liquidity. And the dotted orange line is where we project liquidity to be. Now, it's worth stressing the fact, and to underscore this particularly, is that you can see that the black line has already recovered significantly from the lows. Now, if we look at a timeline on the recovery from the trough, after about 15 months and taking Wall Street as a benchmark, you should already have had, on average, about 2/3 of your ultimate market gains. So we cannot say that there's a lot of return to be had, but there is return to be had out of markets over the next 12 months. It just so happens that, a lot of it has already passed many investors by, and, it's going to be tougher to extract returns looking forward, but there will be returns out there. This is where we think you should be investing. So on the left-hand set of traffic lights, there are asset classes, and on the right-hand side of traffic lights, there are industry groups, so industry sectors of the stock market. The basic takeaway from this chart is we're in rebound, we're moving into calm. What you should have seen perform in rebound are things like equities and credits. They did. What performed badly were things like commodities and bond duration. If you move to calm, you're starting to see, or you should start to see, commodity market performance pick up, which I suggest we are. And then if you look at industry groups, industry group performance should have been dominated by cyclicals, particularly technology, and rebound it was. Calm should see more outperformance from technology, renewed gains from financials, and the beginnings of a pickup from energy stocks, but defensive securities are still very much under a cloud. So that's really the way that we think about markets, and these traffic lights are not adapted for each cycle. These are what we would expect to see based on a long-term history of how markets perform. So what we're saying is this time has been absolutely on track. It looks a very, very normal cycle, despite what the economists claim. Now, to come back to the point about financial conditions and liquidity, the most important, or the most widely quoted, I should say, financial conditions index is the Goldman Sachs index, which is the black line on the chart. The orange line is our liquidity index advanced. It's the 12-month change in it, advanced by about a year to show that it's leading. And what this is saying is that you've got all the gyrations in liquidity have basically driven financial markets and financial conditions consistently, over the last decade or so. So you've got to look at liquidity as most important. Here is further evidence of that. This is looking at the US credit cycle. The black line here is looking at credit spreads, a hybrid measure of credit spreads in the US. That is when that index is high, it's showing that credit spreads are wide. In other words, credits, the spread between safe asset government bonds and credits is very wide. So you've got a big credit spread. As that black line comes down, credit markets rally. The orange that we put on top is the US PMI or ISM index inverted. So it shows that what's happening is that this is a very normal economic cycle unfolding, again, despite what economists say. These are a couple of measures of the US business cycle we like in particular, which is looking at the ISM index, less orders, less inventories, and the US Conference Board leading economic indicator, 6-month change, both showing a recovery. And then finally, a couple of other pieces of evidence. This one is what US chief executive officers are saying on their surveys, advanced 6 months in orange, and US loan officers at banks, what they're prepared to lend as that dotted line. Again, completely consistent, everything picking up. And then finally, this chart, which basically looks at the world business cycle in black. So this is all business confidence surveys worldwide, aggregated and weighted by market size. And the orange line is looking at our index of shipping activity worldwide, which comes from a variety of different sources around the world: China, Singapore, US West Coast ports, European ports, etc. Big increase in that index, jumping higher, largely because of a huge increase in Asia Pacific trade. So that basically is what we're seeing, and I think that that's something that is well worth contemplating.
Okay, yeah. Thanks for running us through that. That's it's fascinating to see sort of how you look at things, and I guess your process of analyzing liquidity and comparing it to sort of the market. So sort of from what you're saying, it sounds quite positive. As you said, most of the equity gains are probably already been had, but there's still that 1/3 in certain industries which are probably going to be available for the
Correct.
average person. Okay,
Correct.
that makes sense. And then if we look at, is that, I guess, a global outlook? Is that mainly focused on the US? Because I guess if we look at China, that hasn't experienced that same increase, probably because of other sort of geopolitical risks there as well. So does that, I guess it's hard for this to be taken into account, the geopolitical risks.
I think there are two things to say, Anthony. One is that one of the things that is always makes sense is to diversify gains. Markets rotate, so we're seeing the US, not surprisingly, being a leader. It always is a leader, and around this stage of the cycle, the European markets and the Asian markets do tend to get more traction. That's the case. The proviso, or what I would add as a caveat to that, is that one of the things I think this cycle has proven beyond others is that Wall Street is the global market for world equity investors in a way that it hasn't been in the same way historically. So if you want your global stocks, your brand names, your technology companies, you go to America, you go to Wall Street now. You don't bother, you don't play around in the UK market as much. The UK market's being eclipsed, but so are European markets by what's happening in the US. So I think you've got to make that caveat. But having said that, it does make sense to diversify to some extent.
Okay, that makes sense. And then if we go back to something that you said previously as well, the PBOC, you mentioned that they've actually been providing liquidity into the markets. And I think that's maybe in contrast to what a lot of commentators have been saying. They've been saying that maybe, and this may be more focused on fiscal, so maybe the fiscal support hasn't been there to sort of help the economy move. Is that the divide, that maybe fiscal hasn't been as strong, but there has been the monetary support going into China?
Well, I think the thing is that what you've got to come back to, and this is, maybe a sort of deeper or more philosophical point, is that we got to think about funding here. So if you come back to fiscal policy, what's actually happening when a government decides to spend money? They have to raise that money, and they can raise that money in one of two ways. They can basically issue debt, or they can print money or add liquidity. And if they're adding liquidity, they're effectively creating new wealth in a sense. They're actually, adding funds to the system. If they're raising taxes or issuing bonds, they're using existing savings or existing wealth. And therefore, what I would argue is that deficit financed spending is more likely to be stimulative than basically spending that is financed by higher taxes or by bond issues. And therefore, what we're seeing in the case of China right now is there is some expansion going on in terms of fiscal spending. We can debate the degree, that's for sure. But the real question is how this is being funded. Is the People's Bank coming in to fund it? And I think that the answer, certainly in the period from June of last year to end of February this year, was definitively yes. They pushed a huge amount of liquidity into Chinese money markets, and that was basically buying government debt or buying securities to do that. They help the funding of this fiscal spending. They admittedly have not been for the last 3 to 4 weeks, but that can easily change. And I think if you look forward, the parlous state of the Chinese economy would suggest that they've got to do something. Now, it seems as if you're getting the first signs of traction coming through for China. But one of the things that the economy needs beyond anything else is some degree of stimulus. So I think that they're going to continue down this road. And as I said, we can debate the size. I mean, we're clearly not going back to the period of a decade ago when China was growing at near double-digit rates of growth. But we probably are going back to a period where the Chinese economy can still see faster growth than the West, because it's an emerging economy that basically needs to see a productivity catch up. And therefore, you've got to see faster growth coming out of it.
Okay, that makes sense. And then you mentioned there that maybe the weaker yen is actually a sort of proxy, almost it's basically currency war against China. It is the reason for that is it's just increasing Japan's competitiveness and providing another competitor on sort of the export stage, or why is that having that impact?
Well, I think the first thing is to come back to this whole concept that what we're in is a capital war. or you might want to call it an economic cold war or whatever, but it's a capital war between the US dollar and basically rival currencies, of which one has to say the Chinese yuan is the obvious competitor currency. China wants to take over the dominance of the dollar within the Asia Pacific region. It's said that explicitly, that's its goal. And therefore, it needs to basically get its currency used throughout the region, if not more broadly in the world economy. Now, America doesn't want this for sure. As I've said, sort of, many, many times before, we're still in what I would call Bretton Woods One. Bretton Woods One was the currency arrangements that emerged out of World War II, which had the US dollar as the main, as the center, if you like, of the world economic system. And that's what the Americans want. That's what they're continuing to that's what they're trying to promote. And a rival, whether it be the euro or whether it be the Chinese yuan, is something that they clearly want to avoid. Now, there are two corollaries of that. One is that if you destabilize the yuan, in other words, push it lower, it becomes far less easy for China to make the yuan the sort of the key international currency or regional currency in the Asian region, because no one will hold a currency that's devaluing. Okay. The other thing, which I think is one needs to think of, is that also within that context of a capital war, America needs its allies. And what better to have an ally sitting right next door to China in the form of Japan, and maybe one can throw into that Korea as well, maybe also add Taiwan, and say these are countries which are on America's side. They're American allies, and therefore you want these economic entities to actually prosper economically. You want them to be strong economies and they're likely to rival China. So it kind of helps that their currencies are competitive at the same time. So you're kind of killing two birds with one stone if you force the yen down and you also, as a result of that, destabilize the Chinese yuan. And that is exactly what has gone on over the last 3 years. And therefore, that's why I use this term of describing what's going on with the Japanese yen as a Trojan horse, which is sort of stalking the Chinese economy or the Chinese yuan. And it's followed exactly that script. What was in place before, which was something called the Shanghai Accord, which was great stability across the Asian currency universe from 2016 until early 2022, it has been destroyed. There's no Shanghai Accord going on now. There's huge instability across Asian currencies, and there's been a massive devaluation of the key currencies against the American dollar. But that's exactly what the US wants.
Okay. And what can China do to sort of do they have to devalue? Can they sort of hold the line?
Well, I think the situation, I mean, the first thing to say is, look, China is in a very difficult situation because through the period of, I mean, maybe one draws the parallel. This is exactly what went on. If you draw the parallel with Japan in the 1980s and then 90s, or the emerging Asian economies in the 1990s or early 1990s and then late 1990s. And what you see initially are huge capital inflows going into an economy. And that was something that occurred in the case of Japan, it occurred in emerging Asia, it occurred in China. That caused the real exchange rate to go up. And if those countries did not want their nominal currencies to rise, then they basically stabilized those currencies, but they let their price levels, and particularly their asset price levels, surge. And you saw that in the case of all three economies. So China had an asset boom. As capital leaves those economies, on the other side of that boom, you get capital exodus, then you get the real exchange rate going down. Now, that either means you let your nominal currency collapse, or what you do is you let your asset markets deflate. And that is what those three economies faced and what China is facing now. So what you're looking at is a lot of downward pressure on the Chinese yuan, or the Chinese real exchange rate, and either they let their asset markets continue to deflate, which is that must have limits, because you destroy your credit system if you keep allowing asset prices to go down, or you devalue your nominal exchange rate. And that's exactly what China is basically doing now. Now, my expectation always was that the Chinese yuan would basically hit 8 to the US dollar. It's currently about 7.3, but it has devalued significantly in the last 6 months, when it was in the high sixes. So you've already had a appreciable depreciation, or significant depreciation. What you're beginning to see now in the capital flow data are signs that capital flows are beginning to return to China. Now, if this trend continues, then you may start to get some stabilization in the Chinese yuan real exchange rate, which means there is a degree of freedom there for the Chinese to actually ease monetary policy while maintaining more stability in the yuan. And that backdrop will be extremely positive for Chinese asset markets.
It's interesting because it seems like a similar theme that you mentioned potentially will happen to Western countries in the coming years as well, with sort of their increasing deficits because of their increasing liabilities.
Well, I
Is
think in
there?
terms of I think that's a slightly different. That's deficits on the government accounts, right? And here we're talking about, we're talking about shortfalls of capital flow. But deficits are deficits, and deficits need to be funded, and that is really what this all comes back to. So I think what you've got is a situation whereby there are a lot of challenges out there. The easiest way to understand the world is through capital flow or flow of funds, and this is what it's all about. Capital flows drive economies. Economies don't drive capital flows, and that's the fact that is making the world very difficult for textbook economics to understand. What we've got is a shift in the polarity of money flows worldwide over the last 20 years. And that's why a lot of these economic models no longer work. And that's why we come back to the fact you've got to understand liquidity and flow of funds, because that's really that's what has been guiding many of our predictions, and it has become an oracle in many ways in understanding economic developments.
Yep, that makes sense. And I really liked your sort of traffic light with assets in different sectors. It's probably my simple brain, but that makes a lot of sense. Sort of when things happen. So you're sort of saying at the moment, equities and commodities are going to benefit because we're in the calm stage, as well as energy sort of slowly starting to come in, and that's probably going to see a longer benefit in the coming months. So those are sort of the key assets that you're looking at, and then duration will sort of benefit at the end of the cycle once maybe there's a sort of reversal in the other asset markets. Yeah.
Well, we may have to wait a long time for bonds to come back into favor. I think the question is that we're in a situation where maybe a little bit like the 1970s in some ways, where you don't really want to be a bondholder because you risk losing your return through inflation. Now, having said that, bond markets are maybe not foolish. They'll try and reprice, and you're seeing yields edging up the whole time. Now, if you're holding bonds, you're suffering a capital loss if yields are going up. But if you're putting new money into bonds, then you're obviously putting them in at each step of each higher rung on the ladder. As yields ratchet up, you're getting a better and better return coming out of bonds. So I think you can't dismiss the fact that particularly at the short end, you're getting quite decent carry, and that clearly is an attraction. But more generally, I would say on a medium-term view, with inflation likely to be slightly higher than we've been used to historically, I can't really see the attractions of government bonds. There's something going on called financial repression, where governments will try and force real yields lower, and they'll try and compel banks and what institutions they can to hold government bonds. They're really an unattractive investment vehicle. And I would much prefer to put money into other asset classes like commodities, particularly gold, precious metals, cryptocurrencies, and equities, where you've still got potential for gains to come through.
Yep, that makes sense. So, Michael, thanks so much for your time today. Really appreciate it. My
Great
last
pleasure.
question is: what is one message that people should take away from a conversation?
Well, I think the one message is to watch liquidity conditions like a hawk. I mean, that's the most important thing to say. And as you know, as I indicated, we may have a situation where for the next 4 to 6 weeks or so, in the short term, liquidity may dip lower for technical reasons. I think the cycle is still upwards till late 2025. But the longer term, I mean, going out 10 years, 20 years, liquidity has got to expand dramatically in the world economy. Another way to think about that is to say, look, um, if you expect to see debt rising as a share of GDP, which is what all economists are predicting, one would have to say, and what governments are factoring in anyway, that public debt's going to rise. You need liquidity to rise relative to GDP, while at the same time to basically refinance the debt. So you've got a world definitively of more debt and more liquidity, and that means you've got to essentially choose your asset allocation accordingly and go into long-term monetary inflation hedges. And that's why I come back to gold, cryptocurrencies, and equities.
Makes sense. Yeah, Michael, thanks again for your time. Really appreciate it. If anyone wanted to find out more about your work, CrossBorder Capital, obviously, would that be the best place to find you?
Well, you can do it. I think the easiest way is via our Substack, which is called Capital Wars. That gives a narrative for high net worth retail investors. We write two to three pieces a week on the Capital Wars Substack. If you want institutional services, that's crossbordercapital.com. Or if you want the odd tweet, the handle is at crossbordercap on Twitter.
Perfect. I'll put that in the description below. But yeah, thanks again for your time.
Pleasure. Thanks, Anthony.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. Good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.